Good morning and welcome to our Market Outlook. This is our 22nd annual Market Outlook. It's hosted by Bender Commercial Real Estate Services. If you don't know me, I'm Michael Bender, one of 6 partners here at Bender Commercial. And on behalf of the entire team, I want to thank you for coming. If you've been before, you know that we hope this information that we present to you the first part of the year is timely, is accurate, and most importantly, is trusted. And you can make business decisions based on that information. So if you've also been here, you know that it's very fast-paced. You don't need to take notes. Within 24 hours, both a video and all the data will be posted on our website. We also do want to welcome anybody who's watching us on the live stream, because we do have video set up for the live stream as well. So with that, I think I'll get into my presentation. As you know from the past, I spend the first part of the presentation and look at the economy from a macroeconomic standpoint. Oftentimes I do it from a global perspective or even a domestic perspective. This year I'm going to do a little different. I'm going to spend some time on some trends that I think are important trends that affect real estate, but they also affect everybody in this room. But before we get into the trends, I do want to I just couldn't help myself and make one statement from kind of a macro perspective. There's no question we are late in the cycle of the economic expansion. Hopefully you'll see and learn more where you think the cycle is. Our industry is much a leading indicator of that cycle. And because we're late cycle, I really think that 2019 is going to be the year of the savvy risk manager. It's time for all of us to manage our risk better. In the end of a cycle, we get a little sloppy. Our balance sheets are a little sloppy, whatever it might be. There's more debt. And this is the year, I think, that we spend thinking about risk management. Because if we risk manage our balance sheets on our businesses, we're going to risk manage our community, so to speak. So it's incumbent upon all the leadership in this community to do that. So I challenge you to think about that for this year. Well, let's look at some of the trends that are out there that I've identified and some thoughts that I've come up with. And there's 6 of them that I want to focus on. The first one, you may or may not be familiar with that phrase. It's called opportunity zone. Embedded in the 2017 Tax Reform Act is an ability to reinvest capital gains in an opportunity zone. There's 4 opportunity zones identified in the city of Sioux Falls. There is $6 trillion unrealized out there that could be reinvested. Many of you probably have unrealized capital gains in properties that you could reinvest. So you're going to hear more and more about opportunity zones in the coming years. These are really trends for 19, 20, 21, several years out. The next one I want to focus on is what I've called hipsterbia, if you will, or urban burb. I don't know if you realize this, but in 2 short years, we've seen 2.6 million millennials move from the urban core back to the suburban core. They're bringing with them experiences that they've had in the urban core. They're demanding that in the suburban core. You're seeing pockets emerge in our major cities of urban, suburban core that are geared towards that millennial group. We in Sioux Falls are doing just the opposite. We're still focused on moving people to the urban core. So we're probably 5 to 7 years behind the coast in that regard. But watch for that trend. Watch for it in our community. You're going to see more and more of that experiential part of the real estate. Reggie's going to talk about it in the retail sector quite a bit. So watch for that. The other one is no secret. Everybody talks about online retailing and online purchasing. And again, Reggie's going to talk about that. We've been beating the drum about the zombie retailers that are out there. I'm going to take it from a different perspective. I think what you're going to see, even in Sioux Falls in the next few years, is you're going to see some online retailers create bricks and mortar presences. You're going to see the opposite take place. Not big box retailing, but small niche retailing. So watch for that trend. It's gonna impact Sioux Falls, and you'll hear of some new store, and it's an online retailer that doesn't have a presence. So watch for that trend as well. And then part of that trend really is the industrial boom that's taking place. Retailers need to have their product as close as possible to the end user. And so Sioux Falls, Rob's going to talk about that. Sioux Falls has already experienced that, and we're going to experience it more, and it's going to impact our industrial market. The last two trends that I want to talk about really are probably threats more than opportunities. They could become opportunities if we handle them properly. And that is, the first one is really workforce housing. Every community across our country is struggling with workforce housing. We're no different here. The cost of permits, the cost of development, the cost of construction, everything is working against communities to deliver affordable workforce housing. In fact, South Dakota's real estate taxes are almost double on a multifamily property than they are in Iowa and Nebraska. We tax at a commercial level, not at a residential level. That's something that we could handle right at the state level, and I would challenge, I know there's people in the audience who are well aware of that, and I would challenge a community like ours to, if we want to tackle that workforce housing, that's something we could talk about at a state level. And finally, the last one that I want to focus on as a trend is really, it's a threat for sure, and that's just human capital. And that's, I put it on as a real estate effect. It's driving up the cost of construction. But we know we have a workforce development issue. Housing's part of that, just actual warm bodies, so to speak, is part of that. So those are some trends that I want you to focus on and think about as you go out in the community and see where we are in some of those trends and how they impact all of us. Let's transition now to the Sioux Falls economy. We always start with job growth, and I want to start first with the U.S. job growth because I think it's important to couch it in that perspective. You can see last year we had a very robust year for job growth. 2.6 million new jobs were created, about 1.6% growth rate, which isn't that stellar, but when you consider it was 500,000 more new jobs than the year before, you can see that was a really strong job growth. How'd the state of South Dakota do? Well, it's much more sawtooth. You can see there was much more up and down. It's still positive growth, so don't get me wrong there, but you can see that we've struggled at the state level. Obviously, ag has a big impact in that number, and I think it's going to continue to have an impact going forward. But 1.5%, 6,400 jobs. Sioux Falls, let's see what Sioux Falls did. And you can see for the first time in a number of years, we fell below both the national and the U.S. And the state average for job growth. That's a little disconcerting. We're slowing. We did predict that last year. We said that we were going to see a moderating job growth in that 2,000 range. Is it demand? Is it a slowing of the economy? Or is it that workforce issue that I just referred to? It's probably a combination of both. But nonetheless, I should point out, Sioux Falls with 2,000 jobs, we're about a third of the economy, the state economy, in job growth. In fact, we're even higher than that. Our sales tax is almost 40% of the state economy. So rest assured, we're still the economic engine of our state, but we're seeing it slow fairly significantly, and the question is it going to continue to slow going forward? Well, if we see slowing job growth, usually we see slowing construction permits. So let's look how we did there. And you know, if you've heard and read anything, we had a record year, $786 million last year in total construction costs. So a little bit of a disconnect there. There's a couple reasons, I think, why we're seeing that record year. Number one, we have a good economy. No question about that. And when you think about most of that record, it was institutional construction. It wasn't speculative development. Institutional construction, schools, large office buildings, medical buildings, whatever it might be, usually has a 1 or 2, maybe even 3-year lag time to get bonded, to get permitted, etc. So what we're seeing is the end result of the last several years of decisions, and that's really bumped up that number. The other reason that I think is really significant, I brought this slide up to you about 5 years ago. because I started to see it creeping into the discussion, and I haven't addressed it since then, but I think it's significant to address this year. The relationship between construction inflation and consumer inflation. I've shown you here the producer price index versus the consumer price index. And you can see consistently, with maybe 1 year in there in the middle, consistently we are averaging 2, if not 3 times the growth in inflation on the construction side than we are on the consumer side. That's bound to be pushing up our cost to do business in this town. This is a national average, I should point out. I actually think if we had a Sioux Falls average, which they don't have one, if we had a Sioux Falls average, it would be even more significant in that regard. Well, let's look now at some of that construction and see kind of where it's coming from. This slide, you can see some examples. It's fairly institutional, as I mentioned earlier, on the new construction as well as the addition remodel. The point that I always want to make in this slide is, are we expanding our economy or contracting our economy? When new addition continues to outpace addition remodel, we're an expanding economy. And you can see that's a nice healthy gap there. So going into 19 and even into 20, I think we're going to be continued in an expanding economy going forward. One thing I should point out on this slide that's significant is, for the first time in several years, one of the top 2 or 3 identified projects was not a multifamily apartment complex. So you're going to hear more about that and what's going on the multifamily side. But just think about that. There's always been a top $20, $30 million project up there. So let's break it down a little further now and look at the new construction. And there's that multifamily chart that I showed you right there from 2015. The city of Sioux Falls took multifamily out of residential and moved it into commercial, because it really is a commercial construction project. So you can see it starts in 2015. We had a peak in multifamily, 155 million. We're off 40% on that number. It's still 93 million. And it's still one of the top categories of total construction, even off 40%. So that shows you how overinflated and kind of hyped that was for several years in a row. But the other ones I want to really point out, last year we predicted that we were going to be flat or stable industrial, stable retail, that we were going to be basically down on multifamily, and we were going to be up on office. And we got kind of right and kind of wrong on that. You can see from the chart right at the end that we're surprisingly, we're up on office. We're just slightly down on industrial, not that much. It still was a really solid year for industrial, and you'll hear Rob will give you a little more input on that. So that gives you a sense of kind of where we were and then what we're going to happen. I'll make some predictions here in a sec as to what we think we'll do in 19. But before we do that, I always like to look at our community in relation to other communities. And this is, I always pick a couple different data points to measure us by. This is our total construction number, that's 786 million. And then I picked a data point of permits. Now I know there's some city folks in the room, so this is really directed towards you guys and gals. Look at the relationship that it took almost 7,000 permits to create that 786 million. And look at some of those other communities, how few permits it took to do $500 million. They didn't need that many permits on a per capita ratio to do the same number. That tells me that maybe we're a little permit happy here in our community, and we're requiring a permit for everything. So I'm on my high horse a little bit, I get it. But it is an opportunity for us to look as a community, and certainly from City Hall's perspective, to look at how we do business and can we streamline things. And I would say to you that that chart alone says that we're a bit permit happy, and maybe there's opportunities to streamline the way we all do business here in town. Focus on the 786, not necessarily on the 7,000 or 6,800, but it's an interesting idea, and when you start looking at relationship, you can see that. So to wrap this up, and then we're going to get into the other categories, there's no question we're late cycle. It's really just a question of where are we in the cycle. As that moderates late cycle, credit becomes a little tighter, employment growth starts to moderate. We're going to continue to see this inflation on the workforce side and on the construction side, and ultimately, what's that mean for where we're going? I think multifamily's moderated 40%, as I've said, in the last 2 years. It probably is going to moderate a little more, but not dramatically. It's not dropping by 50%. Retail, I think you'll hear why we think retail construction will be down. And then certainly office is still pretty robust. You saw that number. It was 92 million last year. So office is going to remain very robust in our community, and I'm going to report on that later on. And finally, industrial, we weren't quite sure to put it on a full-blown, it's going up, so we kind of just cheated a little and said it's kind of halfway. So as you listen to the following reports, I'll be curious where you think we're going to be going into 2019. So that concludes the big macro picture. Now I'm going to bring Reggie up, and Reggie's going to talk about land and retail.
Well, thank you, Michael. As he stated, I'm Reggie Kuipers. I'll be presenting on the land and retail sectors this morning. Let's get started. All right, as we started looking at this from a historical perspective this year and looking at what happened in 2018, we noticed some trends, and we wanted to share those with you. Let me introduce you to the Triple H land effect. The first H is a horseshoe. Now, top of the boundary of that horseshoe is Highway 42. That goes from West 12th Street to East 10th Street, and it comes together in the south central part of our city at a roughly 85th in Minnesota. That's where we're seeing a lot of development activity from a bulk land perspective. The second H is a new high school. That's in the northwest quadrant. And the third H, some really cool things going on in Harrisburg. What's the scoreboard look like for this year? As you can see, we've had 8 bulk land transactions the last couple of years, and we went down this year to 6. The same trend that we've been seeing previously, these transactions getting smaller, less than 80 acres. The days of buying 80 and 120 and 160 acres are not over, but it's much more difficult to get that done today. So from a historical perspective, this is the last 6 years of transactions for bulk land sales, these developer-driven bulk land sales. And as you can see, you can kind of see the horseshoe starting to form there. And we're going to overlay that now so you can see that. And in contrast, we'll layer in 2018 sales. As you can see, 5 out of the 6 bulk land sales last year are in the horseshoe. The other is that northwest quadrant up there. That's our high school site. I want you to look at pricing on this slide. There's pricing ranging from $18,000 an acre all the way to $98,000 an acre. What do you get for $18,000 an acre? That's 40 acres on the very, very southwest edge. That's really not in the city limits. That's a 40-acre tract just north of Baker Crossing Golf Course. That's a land bank site. That developer is going to hold that for a significant amount of time and wait. In contrast, you look on the east side, that's our middle school site, 98,000 an acre. That's a huge number, but that's institutionally driven. Now, go back up to the northwest quadrant. That's our new high school site. That's our second H. We've already sensed some increased activity pick up in the northwest quadrant, but it's primarily driven by multifamily and single-family housing. I wouldn't look for a lot of commerce up there yet. All right, let's go look at Harrisburg. All right, some fascinating things going on in Harrisburg. In 2018, the school district passed a school bond, $40 million. That was an expansion of their high school. But it was also a new elementary school, which is outlined in red. And that's just east of Baker Crossing Golf Course. The current part of that school bond also included a trunk line extension for their sewer trunk. And that's in the green line there. The current alignment of that trunk is just along Minnesota Avenue, just north of the high school site. And in order to service that new elementary school, they're going to expand that 2 miles west and about a half mile north. Now, what that does is it opens up about 600 to 800 acres of additional land that's got infrastructure for growth. As you can see, the orange boundary up there is the southern boundary of Sioux Falls. And the southernmost boundary of Sioux Falls has been roughly 95th and Louise for the last 5 to 10 years. And that's because there's no more additional infrastructure for sewer south of that. And the public was clearly driving this. The public wants to move south. And if And the city has come out, city of Sioux Falls has come out and said they're not going to add any additional infrastructure south for 10 to 12 years or maybe even longer. And because of that, that public demand for south, Harrisburg's going to come north. And so this is going to be a really cool thing to watch over the next probably 3 to 5 years it's going to play out. Now there's a limited amount of sewerability here. It's going to open 600 to 800 acres, and this is a first come, first served basis. So it's going to be a race to get access to this sewer. So after these developers have purchased these bulk land sales, they take all the risk, and now they've got to add infrastructure. And that's curb and gutter and streets and sewer and water, and telecommunications, gas, electric, and a lot of other things, and all the risk. And once they've done that, they've taken it through the city process, and they've figured out drainage and engineering, everything else. Then they break it down and sell it on a per square foot basis. So we're going to look at the per square foot improved land transactions now. Compared to 2017, status quo. 58 land transactions, $48 million, roughly the exact same numbers as last year. Let's break that down one step further and look at category type. As you can see, the last 4 years, that red line is your commercial transactions, the retail commercial transactions. It's been the primary driver of land sales over the last 4 years. But I want you to notice from the peak in 2015, we're down almost 50%. That's a big drop. Multifamily has clearly reacted to the market vacancy, and that has subsided. And industrial's peaked up, and Rob's going to touch on that here in just a few minutes. And it's primarily driven by the contractor shop guys going out buying land and building a new building. Take a look at the retail site. Huge delta, $5 a square foot all the way to $33 a square foot. Well, what does $5 a square foot buy you on the commercial land in Sioux Falls? Goodwill purchased some land on 60th Street North, just east of J&L Harley. That's really more of a flex type of site, but technically it's zone commercial, so it goes in this report. In contrast, $33 a square foot will buy you a high-profile bank location on the entrance to downtown. Now, there's a couple of outliers in the office category this year. 2 huge transactions. Citibank purchased their land for about $4.4 million last year, and also just across 229, just adjacent to the Avera Heart Hospital, a company called Encompass Health purchased 8 acres of land at $15 a square foot. That's a huge number. By and large, the industrial market is held pretty steady, and multifamily has come down a little bit. We're going to transition now and look at retail. I'm going to start this report looking at some vacancy numbers, and we're going to look at some national trends as we always do, finish with a quick sales slide, and make some predictions. The overall Sioux Falls retail vacancy is 15.5%. That's down a little bit over last year, but we kind of think that that's a little bit of a misnomer. We think that's actually going to go back up potentially in the very near term, but maybe stabilize over the course of the year. We introduce you to this horseshoe concept. That's where developers are buying land. That's where the public is living. Let's see how it reacts according to a vacancy report. Lake Lorraine, we'll start there, 12.5% vacancy. This is emerging development. They've started off, they've built a ton of strip mall space. They've absorbed a ton of strip mall space. This is a very healthy number. Now, with the addition of some new strip mall space and some sublease activity, we think that number is actually probably going to go up this year. Take a look at the mall. 8.5% vacancy. Now, this does not include the mall. There's plenty more vacancy in there. This includes the strip mall space just around the mall. This has always been below 5%. It's almost doubled to 8.5%. 41st Street, here's the outlier, 18.5% vacant. Almost 1 in 5 square feet is sitting vacant on 41st Street. What's going on? The cornerstone of opening a retail business in our community for years has been, I have to look at 41st Street. I ask you, is that still true? We're going to watch that this year. We're going to report on it in 12 months and take a look at that. Let's move south. 57th and Louise, 57th and Western, and South Minnesota Avenue. Again, these have historically been very low vacancy, probably between 5 and 10%. As you can see, they're all between 11 and 14%. We've probably overbuilt some strip mall space on the southern portion of our city in the last couple of years, and that's a direct reflection of that. Let's go east. East is Dolly Farm, East 10th Street, Arrowhead Parkway. Huge number, 22% vacancy. Now, it's a little bit of an outlier because we've got some big box availability in there. If you remove that, it's actually a much healthier number. And also, that Highway 100 extension into I-90 is a really big deal this year. And that's going to open up you're going to hear some additional announcements, both the land and the retail, in the very near future on the east side. And that vacancy rate is going to come down this year. Some national trends. As Michael alluded to, this e-commerce has become so prevalent that these bricks and mortar stores are now having to react to this. And what are they doing? Well, they're making this an experience, experiential purchasing, experiential shopping, retailtainment. And a couple of examples of that is you can do a yoga class at Lululemon. You can go in the larger markets, you can go to a Nike store. They're building basketball courts. They're hiring some local high school and college talent. You can buy some new kicks and go shoot around with those guys. An example here is Shields. As a parent, I can tell you that my children love to go to the Ferris wheel and the arcades and the jungle gym, and I can also tell you I never leave Shields empty-handed. And another example is DSW. You know, Bender's been so stressed about this that he's headed to DSW this afternoon to get a new pair of shoes and get his mani-pedi. All right, we're going to talk about big boxes. We've kind of beat this dead horse for a long time, but 2018 was really the year of the knockout punch. And this year, I really want you to focus on what's the reuse of that space. Nationally, we're seeing these be mega churches and car lots and climate-controlled storage, athletic training facilities, and those type of uses. We also saw a local example of that here, that Stan Houston bought the West 12th Street Kmart. I've had a placeholder in this slide for several years for e-commerce and really an Amazon slide. And what this reflects on this year is the year-over-year growth. This is not market share, it's year-over-year growth. A couple of quick facts about Amazon. Now over 100 million Prime members. At $120 a year, that's $12 billion in revenue before anybody clicks buy now. A couple other quick facts is Amazon's got about 48 to 50% of all online retail transactions. In contrast, Walmart has spent billions to compete, and they've got a market share of 4%. We're going to take a look now, go back to locally, back to Sioux Falls, and look at property sales. Nick's going to break down the investment transactions in just a few minutes, but I want you to focus on the transactions went down, the pricing went up. We had some huge transactions last year, and we had 10 transactions over $2 million, and the biggest three was the Shopko on 41st Street, was over $11 million. There may be some regret with that one. The second biggest was that Stan Houston purchase of the West 12th Street Kmart at $5.1 million. And the last one was Vern Ide on East 10th, their pre-owned lot with the Pizza Ranch. That sold for $4.4 million last year. I think we're going to have probably the cleanest cars per capita in the entire country. Car washes have exploded in our community in the last few years, and we're going to see 3 or 4 new ones this year. How long can that last? Dolly Farm, I mentioned earlier that extension of Highway 100 into I-90 is a really big deal. Look for the east side announcements this year. We think the construction's probably going to come down because of all that vacancy. We think the rental rate's probably going to come down a little bit, and the vacancy will hold steady. Even though there's probably some more big box coming available, we think we're going to fill up those strip malls. Where are we at in the real estate cycle? We talked about a high vacancy rate, pretty high construction last year. The other thing we noticed this year was a ton of sublease activity. And because of that, some of those businesses aren't feeling all that well. They're trying to give their space back either to another user or to a landlord. And because of that, we think we're right in the middle of hyper supply. Now, that's not a huge cause for concern. We're a very small, robust market. And if we can abstain from building a lot of new strip malls this year, we're going to absorb a lot of that space and be much healthier in the next 12 to 24 months. And with that, I'd like to turn it over to Rob Fagnan to present on the industrial report. Thank you.
All right, thanks, Reg. I don't have any knockout punches in my presentation this year. I might be able to factor in a little bit of that Bender hipsterbia or something along those lines. But the industrial market, well, this year we decided to drop all the graphs and still highlight some statistics, but really tell more of a storyline of some of the trends that we're seeing here in our industrial market. All right, we always like to start off by just showing you some of the various product types that make up our industrial market. We often like to refer to these collectively as our industrial universe. Now, this includes Sioux Falls, Brandon, T, and Harrisburg. If we rewind back to the 70s, really when industrial construction started to take off in our area, and fast forward 30 years, over that 30-year time frame, we had about 12 million square feet get added to the market. Fast forward to the past 15 years, in half the time, we've added the same amount of space. We're sitting right at about 24 million square feet. So if we're seeing growth in industry, typically the byproduct of that is growth everywhere else. Traditionally, we've always tracked the difference between owner-occupied space and tenant-occupied space in our market. The owner-occupied space is the orange part of that pie chart. We continue to hover right around that 70-30 split between owner-occupied and tenant-occupied space. Our market is dominated by owner users in the industrial world. So 2 key takeaways on this slide. Number 1, if you're a seller and you're thinking about selling and you have your property reasonably priced, you're more than likely going to get it sold. On the other side of the spectrum, if you're a landlord and you're sitting on some vacant space, well, about that 30% of tenant-occupied space, you're only marketing to a small portion of that market, depending on your property type. So landlords really have to try to get creative in how they're going to backfill that space. Let's take a look at some new construction. Despite our construction being down 11% in 2017, it was still a very strong year for industrial construction. It was the second highest on record that we've seen. And I would also like to note that we saw a doubling of the number of buildings get built this past year. And that's primarily due to all these contractor shops that Reggie alluded to that I was going to be talking about that are coming out into the market. And I'll talk a little bit more on that here in just a little bit. Let's take a look at some statistics. Net absorption over here on the left-hand side. We had a huge year of absorption in our market, and that was directly correlated to why we saw the drop in vacancy in 2018 to 3.23. As far as transactions, we doubled the number of transactions that we saw from the previous year. And I contribute that to 2 things. Number 1, owners are realizing that there's some strength in the market still, and so they want to take advantage of that. And number 2, you heard Bender talk about it, inflationary construction. When business owners are going out and they're looking to acquire some land and build a new building, they're getting sticker shock. And so they resort back to, okay, what existing facilities are out there that we can take a look at? And so if they can purchase an existing facility for 20%, 30%, 40% less, they're more than likely going to go that route. As far as rental rates, we've seen very little rental rate growth over the past 3 years, other than the exception of about a 50-cent per square foot increase in that class, kind of the upper end of that Class A space. Now, we are starting to see some landlords drop their prices to fill some of that vacancy that I was talking about. So that's a perfect transition into some of the trends that we're seeing in the market. And I'd like to coin this section of the presentation, the tale of 2 property types: contractor shops, warehouse distribution facilities. And I'd like to start off with contractor shops. The biggest point that I want to drive home here on this slide, if you look up at the top, we've come full circle from where we were at about a decade ago. Many of you may remember back in 2005 to 2007, there was this huge run-up in new construction, absorption, sales, leasing. Well, that's exactly where we've been at these past 4 years in the market. And I think what's happening is that best of times greed is starting to supersede the worst of times fear. We're starting to forget what it felt like back in 09, 10, and 11 with all that vacant space that was sitting out there in the market. And what these owners are doing is they're going out, they're oversizing their buildings, and they're building these buildings to what they want rather than what they need. Any given day for contractor shops, there's about 70 to 80 available units out in our market. So there's a huge supply of that space out in our market. So what landlords have to do, they're going to have to get creative in figuring out ways how to backfill that vacant space. All right, the second trend that we're seeing is in the warehouse distribution industry. And this is a facility that Prologis, one of the world's largest developers of industrial space, built out in Seattle, Washington, in the heart of their city. And it's a 3-story warehouse building. Now, they had to build 3 stories because they don't have a whole lot of land out there. Here in Sioux Falls and the surrounding area, we have plenty of land. So we're probably not going to see this product type in our town anytime soon. But more importantly, what I want to bring your attention to is the logistical side of warehousing. And many people don't think about how product gets from point A to point B. So here enters the trucking industry. So back in the day, you could pick up a load here in Sioux Falls on a Friday night and take it across the country and deliver it in LA come Monday. Great, right? No big deal. Well, one little issue with that. It was illegal. Truckers are only allowed to drive 11 hours out of a 24-hour time frame. So how'd they do that? Well, they've coined a term over the years, since back in the day, creative logging. And that's one of the things that they did during that time is they used, you could see a manual logbook here on the left-hand side of the screen where they would go in and they would manually log their hours and they could make it work. Well, with the advent of e-logs, or what we commonly know as GPS, we're all tracked on our phones. I mean, Google right now probably knows that we're all sitting in this room right now. With GPS. And so truckers are tracked in the same way. Every second, that they're on the road or they're off going to the bathroom or stopping and eating some lunch, these companies are able to track that. And so you might be wondering, okay, Rob, great. What does this have anything to do with the warehouse distribution industry? E-logs? Come on. Well, bear with me for a second here. Let's take, for example, Dallas. Bender's from Dallas, so I'm going to use Dallas. Many of us, horned frogs. Boy, what a vicious animal. We digress. So Dallas, many of us know Dallas is about a 12 to 13 hour trip. Well, for a trucker to legally drive to Dallas, they can't make it in their 24-hour time frame. So they have 2 options. Number 1, they can stop off somewhere in Oklahoma, take a 10-hour nap, and then get up the next day and finish their delivery to Dallas. That would be a 48-hour time frame. Or they can drive down to Kansas City. They can either warehouse that product or switch their trailer to another driver, and that driver can carry on down the road and make that delivery to Dallas, still within that 24-hour time frame. And so with the advent of these e-logs, it's really changing our whole entire trucking industry. And since it was mandated in 2017, it's forcing both the trucking industry and the warehouse industry to go out and build new warehouses all over the country. And that's primarily due to the Amazon effect and e-commerce. We're seeing warehouses pop up nationwide in large cities and even here locally. A few examples locally. Many of you are familiar with the wind chill facility that was built, and even a 200,000 plus square foot addition that was added on that building. We've seen a ton of truck terminals in our market get built over the past couple of years, and we've never really highlighted that in our presentation, and most people never spend time up in those areas, so they never see these terminals being built. But they're the cross-dock terminals where you can transfer product from one truck to the next, and so those have been expanding. We have a 100,000 square foot warehouse being built on spec up on the north end of town. And so where does Sioux Falls fit into this equation? Well, Chicago, for example, if you're taking an 8 or 9 hour, or in Bender's case, a 5-hour drive to Chicago, in that time frame, you have to, say if you're taking a product across on I-90 out to Seattle, you're going to have to stop somewhere and transfer that product to stay legal. And so that's where Sioux Falls really has the opportunity from a warehousing standpoint, is developers or investors who can figure out how to capture that business coming across on I-90 will do very well in the years ahead. Okay, that leads me into my predictions. And that guy up there, he's not signaling for a touchdown or anything like that, but he is obviously feeling good. And I think we as a community are feeling very good with everything that's been going on lately. But we can also look over the edge of that cliff right there and we can see what's below. We just don't know when we're going to get there. You know, are we taking big steps towards the edge, or are we taking little baby steps? None of us know that. But what I do know is here in the market, we're going to have a great year of new construction, another strong year. Probably with the exception of contractor shops until we see some of the demand catch up with the supply. Secondly, pricing across the board. We've seen a consolidation of pricing over these past couple of years, and watch for some pricing to drop a little bit to try to backfill some of that vacancy, as I mentioned, particularly contractor shops. And lastly, the trucking industry. We're at a shortage of about 50,000 drivers nationwide. Now, you're going to think I'm crazy for saying this, but watch for driverless trucks to make their debut in the very near future. Much like the manufacturing industry has implemented robotics to remove a lot of that shift work and work around the clock, the driverless trucks will be able to fulfill that shortage in drivers, remove the need for these stinking e-logbooks that track us everywhere, and then also help with expedited delivery by being able to work around the clock. And so with that, I'd like to just show a couple conclusions or highlight just kind of where we were at in 2018. We had moderate to high construction, low employment growth, and low rental rate growth. We did see a little bit of a pullback, some decrease in vacancy, but with the product that's coming online that we know of already this year, I think we're probably going to see an increase in vacancy, so I just pushed us over into hyper supply for 2018. So with that, I would like to bring up Nick Gustafson to present on the investment market.
Well, thank you, Rob. In this section of our presentation, we focus strictly on investment properties. And my goal is to give you an accurate snapshot of what happened in 2018. So how we're going to get there is we're going to take a look at global and national real estate markets and put them into context with Sioux Falls. And we'll drill down on Sioux Falls and we'll take a look at trends and cap rates. And using these facts, we'll make some predictions about 2019. Now, real estate investing does not happen in a vacuum. There's actually many asset classes that compete for an investment dollar. Equities are common, bonds, options, wineries, even vintage cars, right? Let's take a look at how some of these commonly held asset classes did in 2018. It's no surprise to anyone sitting in this audience that equity markets had ended the year in red, even many commodities. Shockingly, my favorite asset class, First Growth Bordeaux, was down. So let's contrast this with real estate investing. Now, this graph shows global quarterly real estate investments measured in sales, all the way back to 2010, since the recession. This is a very healthy trend line. In fact, in 2018, for the 4 quarters, global real estate investment transactions topped $1 trillion. That's amazing. And in fact, it beat the previous record that was held by 2015. That's incredible. Let's drill down to the national market. This graph is similar to the one that you just saw, but it's just for the United States. Of the $1 trillion of deals that were done globally, roughly 50 to 55% happened in the United States of these investment transactions, which is pretty incredible too. This graph showing sales volume in dollars goes all the way back to 2001. You can clearly see the peak that occurred in 2007, the big drop in the recession, and then a very healthy trend line. Real estate's looking pretty good here in the US, and it's very interesting to also note that prices per square foot are up 30% over the previous peak of 2007. Let's drill down more on the United States market. And this shows office, industrial, retail, and apartment sales volume broken by asset class. 3 of these 4 show a very healthy, strong trend line. Office peaked nationally about 3 years ago and has been just basically going sideways. So it's not enough to talk about sales volume when we talk about real estate investments. We have to talk a little bit about cap rates. This light green line shows U.S. cap rates across all asset classes going back to 2004. Very clearly, you can see competition got pretty intense for properties in the last peak of 2007. Things got a little uncertain. Investors kind of pulled in their horns, and there were some great cap rates or some great deals that happened in that recession of 2009, 2010 in real estate. And really for the last couple of years, cap rates have been hovering around 6.5%. This dark green bar that you see up here is job growth. If and when we enter the next recession, look for this to be strongly correlated again, as there will be some great real estate deals to be had in the next recession. Let's take a look at these national cap rates and let's put it into context of Sioux Falls. Now, it's extremely dangerous to do this. These cap rates that you see here on the national level, multifamily office and retail, these are big properties. There's New York cap rates in here, Chicago, Miami, San Francisco, and these are large institutional grade investments where the appreciation of the property is almost as important as the initial year cap rate. However, I want to draw your attention to the multifamily column. In Sioux Falls, the average of the done deals in 2018 was 7.75% cap rate. That looks pretty healthy. There's a couple reasons I want to kind of drill down on this a little bit. The properties that traded were B and C class properties. Not very many new apartment buildings traded last year. And if you were to take a new 3-year-old apartment building that was full, it would not trade at a 7.75% cap rate. However, there was enough of a delta between this national cap rate on multifamily and the Sioux Falls cap rate where nearly 50% of all the multifamily sales transactions that occurred in Sioux Falls last year were done by out-of-state buyers. We're going to drill down on that in just a moment. But talking about Sioux Falls multifamily, let's take a look at some of the fundamentals that make up that market. This is new unit construction going back a decade. You can clearly see the recession, 9 and 10 and 11, and we had a really healthy trend line of new construction going all the way to 2016. Now, in 2016, our market saw 1,600 new multifamily units built. That's an incredible amount of construction for a market of our size. And really in 17 and 18, you've seen Sioux Falls multifamily developers really pull back. Why did they pull back? Well, let's take a look. Vacancy. That's the answer. The red bar is Sioux Falls multifamily vacancy going back to 2004. The blue bar is U.S. multifamily vacancy. When we started building all of those units year after year, vacancy levels rose. And right now, as of January and February of 2019, nearly 1 out of every 10 apartment units in Sioux Falls is vacant. Now, that's not a doom and gloom slide. We've had strong job growth and we've had strong population growth. This is simply a supply issue. It's not doom and gloom. However, I believe that Sioux Falls multifamily developers and perhaps their bankers will take a hard look at new projects going forward in the next year or two. Let's take a look at sales. This shows multifamily sales going all the way back to 2006. The bar is the dollars transacted, and the number at the top of the chart is the number of sales transactions that were 4 units or higher. Wow, 2018 was a record year for us in terms of sales transactions, crushing the previous record that was held by 2007. What happened here? Well, we had one out-of-state buyer from Florida come in and purchase nearly 600 apartment units. And this totaled nearly $42 million worth of transactions. That's incredible. We had someone who all the way from Florida looking all over the United States, really picking Sioux Falls as an area with strong job growth and strong population growth that they invested $42 million. Let's take a look at some of the two examples of transactions that this buyer purchased. First up is Eagle's Nest, $6 million deal, 80 units. This is late 70s construction, 7.25% cap rate. It's a B or C property here. Next up, Arnold's Park, $9 million or 7.75% cap. That's a big transaction with a high cap rate. This is a local buyer now, so kind of shifting away from the out-of-state buyer. West Mesa Apartments traded $3.4 million or an 8.38% cap rate. That's a pretty good deal. Imperial Apartments just south of downtown Sioux Falls, $1 million deal, 21 units, nearly a 9% cap rate. We're going to switch gears from multifamily. We're going to take a look at a couple of retail and office comparables. East Ridge Mall, this is an East Side strip mall, 20,000 square feet, 7.22% cap rate. West Side Plaza, this is 26 in Marion, $3.6 million, 7% cap rate. Elmwood Office Building, $1.35 million, or a 7.4% cap rate. Sharon Avenue Office Building. This is a newer building on the south part of town, and this traded at nearly a 9% cap rate. What I've tried to do here is to show you that even though there's a lot of competition in Sioux Falls for investment properties, these cap rates show there's still some great deals to be had. So to kind of wrap things up here, in 2018, multifamily sales were up significantly. In fact, my prediction is pretty easy to make. It's going to be hard to beat 2018 in terms of transactions or sales dollars. Office, Michael will get to this in just a little bit, but there was only $18 million worth of office buildings that sold in 2018. It's going to be pretty easy to beat that in 2019. Retail's pretty healthy. There's a lot of investment sales, there's a lot of owner-occupant sales, and we'll see this trend really sideways. My prediction for 2019 is we're not going to see much change in cap rates. Cap rates are going to kind of be in these ranges, even though interest rates are going to rise long term. Not much is going to change in terms of cap rates in 19. So to kind of really conclude things is Michael made a mention of the fact that we're late market. It's a late market cycle right now. And most of the buyers, sellers, and clients I have agree with that statement. We think that we're going to see more investment properties come on the market in 2019 as people who are considering selling in the next 5 years will try to take advantage of the healthy sales that we're currently seeing and maybe take advantage of a market peak. Now, buyers, they also realize that it's late cycle, and they're going to be a little skeptical of projections on these investment properties, and they know interest rates are going to go up, but are still historically cheap. So they're going to try to lock in long-term financing. If you hold any individual stocks or check your retirement portfolio, you know that markets have been a little volatile. We think that's going to continue here. And I just want to highlight in closing that the real estate investment market, both nationally and locally, really depend on employment and the economy. Without tenants to pay rent on a monthly basis, you know, it's hard to invest in real estate. So it's going to truly depend on the local and national economy. We're going to end here with the multifamily real estate cycle. And we took a look at that new unit construction, and we took a look at vacancy. And using these data points, it's very easy to put 2018 firmly in the recession cycle. And in 2019, I think we're going to remain there. Thank you very much. With that, I'd like to bring Michael Bender up to wrap up the presentation and take a look at office.
We're going to finish up real quick here. I appreciate your patience. I'm going to do the office market this year. It's very near and dear to me. I cut my teeth in the office market in Dallas, Texas for 10 years, so I always enjoyed researching it, so I get an opportunity to present the office market this year. We break the office market into a universe of about 15 million square feet. We break out from that 15 million square feet anything that is multi or single tenant or corporate owned, because if it's single tenant or corporate owned, it doesn't have a rental rate, it doesn't go vacant, it doesn't impact the marketplace. So you're only going to see 7.9 million square feet of space researched and analyzed and discussed today. A little bit more about the overall market. The vacancy rate is up. It's trending upwards. It's up since about 8%. 2 years ago, so it's starting to trend upwards, which is an ominous sign a little bit. Our absorption is not that great. It is positive. That net absorption is a real indicator of the health of the office market, and it is struggling to be above the positive line. We're going to talk more about that. Lease rates are static. They're not quite moving up, which you would expect, but there is some positive signs about lease rates that I'm going to show you here in a second. And finally, as Nick pointed out, office sales. Pretty low volume in total office sales. I think it'll be easy to pass that in 2019, but I'm going to show you some examples of that as well. Well, let's break out the central business district from the suburban market and talk first about the CBD market. It's a much smaller market. It's about 2.3, 2.4 million square feet. Rental rates or vacancy rates are going up. They've only gone up from about 6.8% up to 7.2%. So not much movement there. What I wanted you to see, though, is the relationship between that Class A and Class B and C. That's where the big delta is, and we're going to talk about that. That's an opportunity slide that I want to talk about. Net absorption is negative, and we also are going to break out and understand why in the downtown core we're giving more space back than we're absorbing, and yet we have a positive economy going forward. And finally, if we have negative absorption and rising rental rates, why are rising vacancies, why are rental rates going up? So that's something to think about too. So let's look at that vacancy. This is an opportunity in my mind. There are 3 or 4, well, 2 or 3 legitimate potential buildings that could be built in downtown. It will be interesting to see. With that little of vacancy in Class A, there is demand for Class A space. So I challenge, and there's a couple of you in this room right now that are part of that discussion, I challenge you to think about really entitling and getting a new building up and running in 19, started in 20, because there is a need for new space. There's demand for that, and you can see that. There's very little new space going on the market in the Class A sector. And then the absorption, why are we averaging year over year now, 2 years in a row, negative net absorption? That's just not good for that market and for the fundamentals. Well, I think a couple reasons. Number one, there's just not any new space to expand into, and we just talked about why that is. But there's other reasons. There's repositioning, there's demolition of space that's going on. So we're actually removing space from the marketplace. At the same time, a lot of tenants are densifying and consolidating and giving space back. So it's kind of a double whammy. Will that continue? If we probably bring a new building on in the next year or two, I think you're going to see it reverse relatively quick. So I'm not too alarmed by it unless it's a long-term continual growth or continued trend of no growth. Well, let's shift gears now and talk suburban office market. You can see it's more than twice the size of the downtown market. You can see higher vacancy, but you can see a much better ratio between the single or the Class A and the Class B and C. So you can see it's a healthier relationship. That means there's more space coming on the market in both categories when you see those vacancy rates kind of closer aligned. Positive net absorption, I'll show you some examples of that here in a sec. And just the opposite is taking place suburban that was taking place in the downtown. With positive net absorption, you would think that we're taking space, we're absorbing it, rental rates would go up. They've actually remained very flat. Could be that that's a supply issue, but there is demand. That demand is that positive net absorption. So let's look at the vacancy here. Again, the relationship between the A space, the B and C is much healthier. That means that developers are putting space on the market in both categories, and they're growing and they're being absorbed at the same time in a consistent manner, unlike that downtown core. Finally, the inventory, some examples of, you can see it's a really nice, healthy, steady growth of the marketplace, the suburban market. What I would point out, though, is 14 new buildings totaled 90,000 square feet. That's a good sign. They're all small, but one building in downtown would be 100,000 feet. So you can see the relationship. Much more smaller development is taking place in the suburban core to entitle a building, parking, and all the other issues in downtown. It just takes longer, but it eventually works its way through the cycle. So, and then there are some conversions. We've converted other buildings. There's an example of the Joe Foss School that we sold here 3 or 4 years ago is now a multi-tenant office building. So it's in our system or in our research that it wasn't 4 or 5 years ago. So wrapping up on the office market, just some conclusions. There's going to be continual construction in the suburban market. It's going to be smaller. It's going to be a lot of tenants that want to own their own building and maybe just build one spec space next to them, kind of like what Rob talked about, the contractor shop. So you're going to see that in the suburban market. The downtown market, I challenge you, who will be first? Because they will benefit from building a downtown building in our environment as it sits right now. A vacancy, I think, is going to just remain, it's going to bounce around. If we have some speculative space come on the market, it may go up a little bit. But I should point out, we usually throw a slide up here that shows you the relationship between the national vacancy, much like what Nick did with the multifamily, the national vacancy and the Sioux Falls vacancy. We are consistently 2 to 3 percentage points below that, and we were again last year. So that just bodes well for our local economy going forward. Rental rates, for the most part, are going to remain flat unless we see some major consolidations that we're not predicting. We're not going to see rental rates drop too dramatically, so they're going to remain fairly steady. So where does that kind of put us on the office cycle? You've seen this now several times. we're clearly in that hyper supply. We could stay in hyper supply on the office market for easily 2 or 3 more years if we add a downtown building, for instance. I don't think we're going to reach that recessionary level on the office market anytime soon because there is demand, there is speculative development, credit is still available. So that kind of wraps up the office sector. Now, before I conclude and let everybody adjourn, I want to remind everybody, this is my reminder, to get you to take one of our wireless cell phone chargers. We've got them at both exits. We've been using them. They work great, actually home or office, so if you want, take one for your home as well. They work on all the iPhones and the Samsungs, so we'd appreciate you taking one of those. And I would be remiss if I didn't acknowledge someone that's in the audience and thank him for his service. As many of you know, Mike Cooper has announced his retirement from the city of Sioux Falls. He's ably led our planning department. He's led our parks department. And Mike will be missed. I know he's looking forward to retirement with kids and grandkids, but I can tell you he's had a passion for our community and for the growth of it and the direction of it. I've also lost a number of bets every year about our total construction to him. He's always much more optimistic than I am about that, and he's right. But I want to just end our program this year with a community thank you to Mike Cooper. So you're adjourned.